Beautiful. All right. Well, I'm happy to host the latest webinar in our Peak Performer webinar series. This series is designed to support your leadership climb. It brings the most trusted experts to the Vistage community to provide exceptional insight and best practices to help you navigate new challenges and possibilities. Today's focus is on tax planning. We've invited James Jack and Brad Dillon from UBS to discuss key considerations around tax planning, reviewing some things to take advantage of in 2020 filing, and looking ahead to planning for 2021. James Jack is the head of the UBS Business Owner Client segment. In his role, James is committed to understanding all aspects of business ownership and creating resources to help and support business owners and entrepreneurs. Brad Dillon is a senior wealth strategist in the advanced planning group at UBS. As a formerly practicing trust and estates attorney, Brad works with ultra-high net worth families, helping them achieve their tax, estate planning, and philanthropic objectives while maximizing tax efficiency. Brad is also an adjunct professor of law at Fordham University School of Law, where he teaches trusts and estates. So welcome to both of you. And as we get started, James, I want to help me understand, how have your conversations evolved over the course of the year, and what are you hearing from business owners today?
Well, Anne, thanks so much for having me and Brad. It's been a kind of a wild year, as I'm sure a surprise to nobody. In the last less than 12 months, it's been 51 weeks since I've been in my office. So it gives a kind of a morbid date to be thinking about. But business owners in my conversations, right from the very beginning, we started talking about the pandemic and what does it mean. And I think the first thing when we started out was a sense of, there's so much going on. I don't know what's going to happen. Can you just help me a little bit? We then transitioned a little bit into, once we got through the summer, which was all about PPP. How are all the rules changing? What's the latest thing? What's the latest change here? And so working through that, a lot of questions about, well, I kind of think back like fondly in a sense of, all the restaurants who are saying, well, should I wait a little bit longer to get this loan, or or now because of these timelines? And I think the good news, now that where we situate now, is a lot of those concerns, I think the government did what was right and said, our situation changed versus when the law was passed in March. And so I hope business owners know that they're trying to make it as flexible for you all as possible. So that was, I think, a lot of my conversation for most of the 2020. I think now it's really evolved into, well, there's still PPP, but also, well, what about M&A? I was thinking of selling my business or monetizing my business in some way. Did my valuation totally get shot or not? There's a bit of a tale of two cities there. Some businesses are doing particularly well. Valuations are strong. Other businesses have been impacted particularly negatively. And so they might be waiting a little bit longer. So we're having conversations about that. And then, and I think a lot of what we're going to talk about today is, well, what is that goal of potentially monetizing or thinking about, what does that mean for the future of my business in terms of, we've got a whole new administration. We now know that there's a 50-50 split. That was who's going to win. We're all past that now. We've got some certainty on that. And so what does that mean for my business's taxes, my personal taxes? What if I do want to monetize? What if I want to use a gift and estate tax rules for my family or my personal things? So those are where we're now at this stage of the game. And it's kind of a guessing game as to what may come up in the next few weeks and months.
Excellent. And just going back to the last 51 weeks, what was it that business owners discovered, maybe out of necessity, that came out of the pandemic?
Well, I think the obvious answer is being able to adapt and pivot. We've heard that word. We've heard resilience a lot. And so the businesses that have been able to do that really well have done well. But I'm going to give another answer that I think is that in my conversations has been really interesting, which is, I think a lot of business owners have discovered the importance of their community, more so than just of course our communities are important, but I think a lot of business owners now get a sense that the communities really do care for them and they want to give back to their community. They want to give back to their community of employees, their community of suppliers, their community of customers. And so we're seeing more conversations about that. We're seeing, key themes from last year: sustainability and social justice, diversity. Those are becoming much more rapidly conversations for middle market business owners than I would have thought back in May last year, right? And so, a lot has changed. And so, of course, adapting, being able to pivot, changing your marketing, doing whatever you need to do to keep your employees safe, obvious, that's what's changed. But also thinking about the next 12 months, 24 months, I think there's going to be a lot of pressure, both from the outside world, but also from business owners themselves, to say, how can I give back to my community who were here to support me in these many trying times? So that's what I'm seeing, and hopefully we'll have resources over, for whether it's from UBS or Vistage or any other organization to help business owners really, take that theme and run with it.
Excellent. I know we're forecasting that the recovery will happen this year, so there's a lot to be said about what we went through and what we're going through. Brad, I want to turn to you. What are you hearing from business owners today?
Well, thanks for having me. I really appreciate being here and all the people who joined to listen in. My focus is much narrower than James, who deals with business owners with a myriad of questions, where I'm a tax lawyer. So business owners typically come to me with singular questions about tax legislation, tax laws. And that's really where the focus really has been, which is, last year in 2020, it was all about who will win the election and what will the rules be if that person wins. And this year, we know who's won the election. We know the Georgia Senate runoff races, the outcomes. And now the question is, with this split in the Senate, what kind of legislation are we going to see from the Democrats? And that has been a huge focus for business owners today. And dovetailing off of that a little bit and talking about the M&A activity that James was speaking to earlier, a lot of business owners are thinking, well, if some of these taxes are going to be increased, imminently, should I be thinking about selling my business now to sort of accelerate that sale into a time of lower rates so that, I can get more bang for my buck during the sale or not? And so those are the big questions I'm grappling with. Or what are the taxes going to be? How will it affect me? And should I sell my business if taxes are going to go up?
Well, that's a great point, and there do seem to be a number of potential tax changes that a Biden administration would like to see, including changes to corporate taxes, individual income taxes, Social Security taxes, and even estate taxes. So before we get into the details of some of these—
A lot of taxes, Ann.
Well, that is a lot of taxes. Before we get into the details of these changes, can you touch on where you think the Biden administration will focus?
Yeah, I mean, I can touch on it, but I can't say with any certainty, because that's sort of the big question, which is, there are all these proposals listed here on this slide, which we'll get into some of the details here in a moment. But there are so many big proposals, and we don't know which of these are going to come out. We don't know which ones they'll focus on, but there are some clues that we're trying to pick up along the way, particularly in Treasury Secretary Janet Yellen's comments during her confirmation hearing, interviews since then. So she has indicated a big focus and push to raise corporate taxes. She thinks there's appetite to raise the corporate tax rate from its very recently lowered to 21% rate. That was from a 35% rate to drop to 21. They want to raise that up to 28%, and she thinks there's appetite to do that even in this economic environment. However, she's indicated that we may be waiting to see a little bit more data come through for the economy to see where it's picking up, how fast it's picking up before the Biden administration really tries to come after that. And our UBS Office of Public Policy agrees with that statement, that they believe that the most probable changes to taxes this year are corporate tax rates and the highest individual income tax rates, which are right now they're 37%, raise them back to the Obama era rate of 39.6%. So the UBS Office of Public Policy thinks that's very likely. A little bit less likely maybe changes to the capital gains rates, which we'll talk about, increasing those. There may be some political stagnation there along the way and pushback along the way because of a couple of Democratic senators who come out who don't seem to be particularly in favor of raising those rates, but less likely, lower on the probability scale, at least according to our Office of Public Policy here are changes to the estate tax and changes to the Social Security tax. But I want to stress that this is anyone's guess. I mean, we're really picking for clues along the way, little bits, and Yellen is Secretary Yellen is very well known. We all hang on the words. When she was chairman of the Federal Reserve, we all hung on all of her words. We're still doing that as Treasury Secretary, hanging on all of her words, trying to wait and see what clues she may give to see what changes to the tax rates may be in our future.
Okay, so you are saying you don't think that that they will prioritize certain tax changes, or that, and rather than going for everything at once?
Yeah, I mean, that's she gave a little bit of a clue to this last week in an interview where she said that she thinks that tax changes will be proposed this year, but those tax changes may be implemented over a multi-year period. That's as much of that's the biggest clue we've really gotten about it. And so, more, and yet a little bit more to come, I think, in the coming weeks and months to see what's going to happen there. I think, again, it's all going to depend on the economic recovery, how quickly the vaccines are rolled out, whether or not herd immunity it comes to fruition. All of those things are going to kind of start congealing over the next couple months. And I think then the administration is going to take this wait and see approach to see how aggressive they can really be on some of these proposals or not.
Okay, so if you think they ultimately may prioritize tax hikes for corporations and for certain high earners, and any more detail that you can discuss for those proposals, or that's the wait and see?
Yeah, I mean, we can discuss the details based on what Biden has proposed and what many of the Democrats have proposed. Many of them the Democratic senators who were running for president, this time last year. But those changes to corporate tax rates, for example, like I said, are 21% raised to a 28% rate. Another change is that, under current law, under the Tax Cuts and Jobs Act of 2017, we eliminated the AMT, or alternative minimum tax, for corporations. We don't see a reintroduction of an AMT, but it's kind of like, it creates a 15% kind of like AMT for book profits for corporations with more than $100 million in book profits. So it's a little bit different, but creating a 15% AMT for those. And for capital gain rates, it's right now it's 20%. The potential raise all the way up to the ordinary income tax rate for those just with incomes over $1 million, all the way up to 39.6%. That's a huge jump. I think it's very improbable that would be raised to that high of a rate, almost doubled at that point. And the word on the street, again, picking up little clues here and there in our UBS Office of Public Policy, thinks it's going to land somewhere in the middle, or actually just slightly below the middle, maybe at a 28% rate or something, maybe similar to the corporate income tax rate. So raising the capital gain rate to 28%. And then again, the ordinary income tax rate, those are the ordinary income tax you pay on wages that you earned, that they're taken out of your paycheck. The highest marginal rate, again, just over $400,000. All of these proposals, just to stop for a moment, that are really just for the highest earners. And note, by the way, that under the Obama years, the highest earners was considered $250,000. That was the threshold. Anything above that was considered highest earners. So that's where President Obama at that time was looking to raise rates. Here, just 4 years later, after the Trump administration, we're seeing the highest earners be $400,000 and above. So a huge jump in what is considered highest earners, but Biden has proposed just an increase of over $400,000. So the ordinary income tax rate of 39.6% wouldn't hit until $400,000. And again, and then even the Social Security tax, which is creating a little bit of a donut hole right now. There's 12.4% Social Security tax on income up to 142,000 or 142.8. But that same proposal, except that's going to be identical under the Biden proposal, except it's going to kick back in at $400,000. Why? Well, he's promised he doesn't want to raise income taxes for those making less than $400,000. So we're going to see it stopping, that 12.4% Social Security tax stopping at 142.8, and then kicking right back in on wages earned over 400,000, all the way up to the maximum. There's no maximum amount there, all the way up to as much as one earns through wage income. So those are some of those big changes that we might see that I think are, sort of on that list that many of the Democrats are in favor of. The Democratic senators who are going to be a key part of this, any legislation that's ultimately passed. So again, we're going to kind of wait and see, but this has been the sort of standard talking points for not only Biden, but many of these Democratic senators now. Now we're seeing Secretary Yellen as well. So this does seem to be the baseline. There's going to be negotiations along the way, pushback, of course, studies that come out from the OMB, things like that, that are going to probably change some of these numbers along the way. We'll see, and we'll wait and see what comes from that.
Okay, thank you so much for setting that table. And James, with that in mind, what do you think this means for business owners?
Well, I think a few things to unpack there. And I think, regardless of what the actual numbers change to, I think it's very clear that taxes are going up. I think everyone can leave this, very, very rarely can I say, oh, here's what seems to be an absolute certainty. I feel, I'm at 99%, I'd say personally, that taxes are going up, most likely for the people personally on this call and their businesses. And the reason why I feel that way is because we just spent what, $6 or $7 trillion in the last year on the programs to fight the pandemic. So of course taxes will probably have to change. And even if Congress does nothing, taxes will go up at the end of 2025 based on the current legislation. So using that in your planning, very helpful. Talk to your tax advisors, your corporate controllers, and begin thinking about that. What does that mean for your business? That's number one, I'd say. I think also on the other part for what it means for business owners is, you're going to have, how does your business get impacted and how do you get impacted? And if you look at all the things on the right-hand side of that slide, again, people personally are going to be impacted. So maybe your planning work that you could have delayed a little bit, you might want to begin doing more of that work now. Thinking about estate planning, thinking about how you're going to change things in terms of, if I'm looking at the examples, if for example, the capital gains rate does go from 20 to almost 40%, well, that's going to be significant on, if you do monetize any piece of your business. And if the step up in basis is no longer allowed at death, well, that's also, a significant change for your heirs. So how can you potentially use right now the, 11.7 million estate tax exemption to your benefit, into your heirs' benefit before some of those things get kicked in? So that's what Brad and other tax advisors and other advanced planners, financial advisors at UBS are contemplating, and how it connects to their business on a long-term strategic planning about, are we going to invest in our business right now and grow it so that way we can, increase EBITDA and get the multiple lever and get out of this business, or, some other version of that. Maybe we're going to, diversify, in terms of what types of businesses we're in or locations. So it comes in both ways there.
Okay, and we have to ask, because I know it's very top of mind for our members, but what about the Paycheck Protection Program as it relates to taxes? Are there differences at the federal and state levels?
Unfortunately, yes. It would be great if I could tell you, no, it's all the same, perfect. I guess one of the benefits of our federal system is we have all these different states competing against each other. But on the negative side is, there are differences. So one big win, and I'm fairly confident everyone knows this, but just in case, originally the CARES Act said, the forgiven indebtedness of PPP is tax-free. And most states, said, we're on board, we agree with that, right at the time. Where there was some controversy, I'd say, was that if you're using the expenses that would normally be deductible, most of last year, the IRS was saying, well, you can't get both. You get one, you get one or the other. And the Economic Aid Act in December finally answered the question and said, at least federally, you get both. That was the intention, and they've resolved that. Okay, great news. However, states have now come up and said, and are showing differences. So there are some states that agree entirely with federal rule that they're both tax-free and can be deducted, and others that you only get one or the other. And so really speak with your local tax advisor who's going to know the local jurisdiction rules, whether for city or state. New York City also has different rules as an example, and how that can compare, but it could definitely be different is the long and short of it. So don't count on it being the same.
Okay. Brad, let's come back to you and talk about some of the proposals. Assuming some of these proposals make it through Congress, when can we expect to see any of the things that you touched on today become law?
Well, that's a great question. I want to touch really briefly on James's topic about the difference between federal and state, which is, I looked this up yesterday just for this question to think about it, but 23 states are not following the federal rule, and 27 states are following the federal rule, which is full deductibility of PPP expenses, full deductibility of the loan, no income indebtedness from the forgiveness of indebtedness. So 27 states, including New York, are following federal. You don't have to worry about it, but there are 23 states, unfortunately, that will not. They're going to have mismatched rules there. So again, this is a crucial time to talk to your accountant about any of these things. But back to your question, and to be thinking about, even if these proposals that we're talking about from the previous slide become enacted into legislation, the big question, the $1,000,000 question really is, well, when is that going to happen? When will these laws become effective so that they actually affect us? And that's such an important question, because, well, we don't know when any of these are going to come down the pike, but even bigger than that, there are a couple of well, one of the big things is there's a concern that some of the legislation could be made retroactive. Retroactive to when? Well, it could be retroactive January 1st, 2021. So that's something we're waiting to see. There's no constitutional procedural hurdle in the Senate or in Congress that prevents retroactive tax legislation or prohibits it. So it's something we're watching out for. We really hope that none of the legislation is retroactive to the beginning of the year, because that would create a lot of really disgruntled taxpayers and tax advisors, including myself. But a lot of them, will it be prospective to January 1st, 2022? Well, here's hoping. Or will it be effective on the date that it is enacted? And we don't know. And it's sort of a common, unfortunately, a common theme coming through. I just wrote an article for UBS called, Tax Planning in an Uncertain Year. And the whole gist of it, the directive from my boss was, hey, write an article about, like, now that the Democrats have won, what should businesses be thinking about? What's the news on tax legislation? And I told her, I said, well, there's not really much to say because we don't know much. So the article is really about how we don't know much. And the answer to that question is the same, which is, when will these become effective? We don't know. Will they become retroactive? Will they be prospective? Or will they be the date of enactment? Those are big things we're all really waiting with bated breath to see and determine, so that we can advise our clients more effectively. So again, we're just waiting. So waiting for a light in our dark from Congress, or someone from the Joint Committee on Taxation, or from President Biden, or the Senate Majority Leader, someone who says they're not going to be made retroactive. That alone will cause a lot of us tax lawyers and advisors to exhale. Again, it's just, we don't know a lot at this stage. We're waiting and seeing, and hoping for the best.
Okay, thank you. And
if,
yes.
sorry to throw you off. I just add a little bit on there is, I also wouldn't hang your hat on, the fact that it's a 50-50 Senate and it's so difficult to get anything done, because what will likely be done for tax changes is the reconciliation process, which is how Republicans got the 2017 tax law in effect. And that only requires a simple majority. So, which still could be very challenging. You have moderates on both ends that do a lot of control and have a lot of power here. But most legislation requires 60 votes and all those things. This may not, and so I wouldn't count on the fact that they're never going to get 60. So we're in the clear. It could happen.
Yeah.
Okay.
It's a touch really briefly on that too, which is that, this is one of the reasons I think the UBS Office of Public Policy sees some less likelihood for changes to the estate tax rates and even the capital gain rates, for example, is because, Joe Manchin from West Virginia and Kirsten Sinema from Arizona, both two moderate Democrats, both of them have already come out against that $15 minimum wage. You're seeing those two moderate Democrats have been against making the estate tax more aggressive, have been against retroactive changes. So, and you're going to need, even for budget reconciliation, you're going to need every last Democrat on board, unless you're going to pull some Republicans over to the Democratic side. And so it's a big wait and see. How are those two moderate Democrats going to vote? Will any Republicans defect and come on board with some of these changes if they can negotiate? It's a big if, and it's gonna really impact what changes we see ultimately.
Okay, well, talking about changes, are there any other business related provisions, Brad, other than the PPP changes that we talked about that business owners should know about?
Yeah, so there's one big one that came out at the end of last year that President Trump signed into law in December. Well, so the CARES Act that came out in March of last year, 11 months ago now, provided a refundable tax credit against certain employment taxes of up to $5,000 per employee for qualified wages that the employer paid to them in 2020. So there is a new law, the one that President Trump signed into law in December, that provides even more of a credit. This is the employee retention tax credit that's on this slide here that shows the difference between the original and the new law. These many more businesses should be able to avail themselves of this credit than were able to in 2020. So the new law provides even more of a credit, up to $7,000 per employee per quarter in the first and second quarter of 2021. So that's for up to a total of $14,000 per employee for the first half of 2021. Employers can still reduce upcoming deposits or even request an advance credit through a newly released form called Form 7200. So employers, including tax-exempt orgs, are all eligible for this credit if they meet one of two tests. The first being that there is a full or partial shutdown due to COVID in the first or second quarter of 2021. That maybe seems less likely now as we're coming into the year and the case numbers are going down. Governors are opening up more businesses, so maybe you won't qualify under being partially or fully shut down. The second test, however, is excuse me, if there is a significant decline in gross receipts in the first or second quarter of 2021 as compared to 2019. If there's a significant decline, then you qualify for this credit. Again, up to $14,000 per employee for the first half of the year. That's a huge credit. But don't worry, if your business didn't exist in 2019, to meet that test, employers can still claim the credit. There are different rules. And finally, the credit's availability has been significantly expanded. As you can see, the original law versus the new law. So under that prior CARES Act law, one of those things there is that those who took a PPP loan could not take advantage of this credit last year. Well, that rule has changed under the new bill, so that employers who take a PPP loan will qualify for the credit with respect to wages that are not paid with forgiven PPP loan proceeds. So all around really good news for businesses and taxpayers. From this slide, I want to point out 3 reasons why businesses should be able to take advantage of the credit more so in this year versus last. So again, under the CARES Act, businesses had to show that they had a 50% reduction in gross receipts over comparable quarters. That's a huge drop in gross receipts that they had to show last year. This year, businesses only have to show a 20% reduction. So a lot more businesses that weren't hit as hard or aren't being hit as hard this year should be able to take advantage of the credit. Second, the original credit did not permit businesses with more than 100 employees to take advantage of this credit if those employees were still working. The new bill increased that limitation, that 100 employee limitation, to 500 employees. So now bigger businesses who, again, continue to pay their employees should be able to continue to take advantage of this credit, maybe now for the very first time. And finally, again, as I mentioned, those who took out that PPP loan weren't able to take advantage of the credit in 2020, but now, again, they're going to be able to, so long as those forgiven PPP loan proceeds aren't used to pay the same wages that the credit applies to. So again, all around really, really good news for businesses out of that relief package from later last year. This is a complex topic. I encourage everyone on this call, particularly if you think you're down in the first or second quarter, just 20% as compared to the same quarters in 2019, talk to your accountant and see if you qualify for these wages. They up to $14,000 put back in your pockets. And right away, you can monetize this credit right away this year for every single employee. So it's a great law. To James's point earlier, they're really trying to put liquidity in the hands of businesses that are suffering.
Excellent. You mentioned if a business didn't exist in 2019. So what about the businesses that did unfortunately launch in January of 2020? What are the options that have been available to them?
Yeah, you'll still be able to take advantage of the credit. The rules are just a little bit different compared to, you can average out credits from the years that the quarters that you've been in existence, but you have to have been in existence by March of last year.
Okay. And then PPP loans are not even available for those businesses, right? Because they don't have any 2019 receipts.
It's you have to have had an employee as of February 15th, 2020. So up until then, if after that point, you're not eligible for either a first or a second draw loan.
Okay, excellent. And so let's keep going around PPP then. So James, what are the new developments and details with the Small Business Administration's PPP guidelines? And can you take us through what those updates are?
Sure. I'm just going to take down the slides for a minute, just so we're done with our slides. So in terms of what's been changing, so listen, the name of the game with PPP is like, what's the latest rule change that we can throw at everybody today? And sure enough, that hasn't changed. So, meet the new boss, same as the old boss, I guess, in a sense. But they've made some recent change that were effective on Wednesday that will, for the next 2 weeks, that will effectively allow companies that have fewer than 20 employees get priority for a PPP loan. So the SBA is only going to be reviewing those smaller businesses, which is the overwhelming majority of businesses in the United States. But if you have 20 or more employees, do not wait, do not stop what you're doing, continue working with your lender and get your applications in order, get everything ready so that on March 15th or whatever date it is, that they can submit your application and you can get going. So don't stop. But the good news is if you are a smaller business owner, the idea is that hopefully that you can get a little bit more guidance, a little bit more attention from this, and that's a big part of it. Some other changes that have come in is that if anyone here is an independent contractor or a sole proprietor, they've made some changes that made it so that you can get a bigger loan. So they were finding issues that, once you got down to your kind of net income, a lot of businesses try to, zero out their income so that, that they're limiting their taxes. Well, that means you get almost no PPP loan in that sense. So they've made a change now that, and I think it will be effective on Monday, and there's going to be some rules that will come out on how they'll do it. But I think the idea is that people can come back and reapply to get a little bit more. You're going to start using total income rather than your net income. So that's a nice change for those folks. I think the other thing that is important for everyone on this call, whether if you've done a first draw or a second draw, is you have until March 31st to apply. And as of now, there is no indication that they're going to extend this this program. It could possibly happen. It's happened multiple times already. But as of right now, the Biden administration has said that they are not asking for an extension of PPP in the $1.9 trillion bill. Instead, what they're asking for is some slight other programs, perhaps for restaurants and for music venues. So they're thinking of an alternative method rather than PPP. So assume that you only have until March 31st. And I think the other thing that everyone should know is this go around on PPP, the SBA is taking a lot more time to review applications. And so even applications that were approved last year with all the documentation are now being rejected. And so this is an industry-wide issue. The lenders are working through it, but basically the media did a very good job of making it out to be that there was extensive fraud with this program, which is not true. But because of that, the SBA is hyper-focused on it, which is both good and bad. It's good because they are finding fraud that it's working out, but it's bad because now it's taking weeks to get loans approved, even for smaller loans. So I wouldn't be shocked if there's an extension or a new version of it, but right now the program is set to expire at the end of the month.
Okay, and that March 31st deadline, is that to submit your application, or is that when all the funding's stopped?
It's to submit an application.
Okay, great. From a tax standpoint then, Brad, can you take us through what some of those updates are and how that might affect owners?
Yeah, I mean, we touched on this before, but it's worth repeating, especially in light of the kind of bad news that James just mentioned, that maybe these will all be over. But, so long as PPP loans are used for qualified expenses, they can be forgiven. And the IRS stated, or not the IRS, the legislation in the CARES Act specifically stated that the forgiveness of those loans would be excluded from gross income for, again, federal income tax purposes, not necessarily state income tax purposes. But usually when a loan is forgiven, the debtor that it was forgiven for has to pay income on that forgiven amount. But the CARES Act specifically excluded that from gross income. That's a really nice take, that, you know, we'd be getting all these funds forgiven and we'd still have to pay tax on them. But the second thing that we also touched on is that, you know, the IRS in May, after, you know, a lot of questions began to arise about the tax attributes of these PPP loans, the IRS in May of last year asserted that otherwise deductible business expenses should not be deductible if it was expected that the loan used to pay those expenses were going to be forgiven. And that makes sense. You don't want to, you know, they didn't want you to double dip, to get a free loan that's forgivable, not included in income, and be able to use those loans for deductible business expenses and be able to take a deduction. You're kind of double dipping in that way. You know, this came as a really big surprise to most of us, including myself, that that they wouldn't allow that, because you're kind of forcing them to pay a tax on these forgiven loans during an economic, you know, downturn, and we're trying to prop up businesses here. So came as a surprise. Even after a bipartisan call to reverse that IRS rule, no relief came, but it did come finally under the new legislation that President Trump signed into law in December. And again, under that new law, it bears repeating, Congress clarified its original intent that PPP funded expenses are in fact deductible as usual. So, and again, this is just for federal purposes. Your state, wherever you are, may disagree with that assessment, but for federal purposes, PPP loans can be used for otherwise deductible business expenses. So again, this should come as really welcome news for everyone.
Great. And regarding that second draw of a Paycheck Protection Program loan, what forgiveness rules have changed? So James, for those owners who may not have participated in the first round, but are interested in taking advantage of this opportunity before March 31st, where can they get more information?
Yeah, I mean, we could spend an hour webinar just on that, and that's not the intention of this, but I think a lot of people are in different stages on it. So first, what I'll tell you is, there's no rush to submit for forgiveness. You have 10 months from the end of your covered period. So for most people who got a loan in 2020, that 10 months is probably not going to be until at least the summer of this year. Now, that said, if you've got the time, if you've got the capacity, you know, go ahead and submit it, and, you know, let the process take its prior. It takes a while. So once you submit it, it's like 2 or 3 months from that process. So I want you to know that, but I also want you to know that there isn't, you know, you've got time. So that hopefully will help some people here. That wasn't a change though. What has changed, the key thing on change is the fact that you can have more things count as a forgivable expense. And I think what might be very helpful tip for folks here is that how the rules are written, and it's a little vague on this, so speak with your tax advisor and your lender. But when you submit a forgiveness application, assuming you have a bigger loan, you submit how much you spent on forgivable actions. That amount could be higher than your loan amount. So you may have had $1 million loan, but you spent, you know, $2 million in the 24 weeks that you had. Well, with that additional spend, if you're then impacted by a reduction in FTEs, let's say you laid off 50% of your employees, and you're impacted by that calculation. Well, $2 million spent times 50% is $1 million. $1 million is still equal to your $1 million loan, and that's forgiven. That's a little that's something hidden in one of their recent FAQs that came out in October. So think about that. If the more that you can claim that you spent on forgivable expenses, that it could be better for you. Remember though, that may have other impacts, like using the employee tax retention credit and some other things. So, you know, think about that through. Don't just go wild on it. But that's one, I think, a tip that would be interesting for folks. And then the other thing is, if you've got a loan that's $50,000 and less, you effectively have auto forgiveness. They don't call it that, but you are exempt from all the full-time equivalent requirements. It's in you get to use a simplified one-page application, and you're exempt from that. If you're 50,000 to 150,000, this is a change in the rule. You get to use the one-page application, but you are not exempt from those full-time equivalent calculations. You still have to do them. You just don't have to show your work when you submit your application. So clear as mud, sure, but there are some interesting strategies They did try to make it a lot simpler for you so that you're not as beholden to all of those full-time equivalent requirements. But particularly, if you're 50,000 and less, which is the overwhelming majority of loans, you're basically exempt from that. Others have other exemptions that they could take advantage of. So it's all, you got to really read the rules. We've got resources, shameless plug at time, ubs.com/business-resilience. We've got tons of detailed PowerPoint presentations to review. And we actually have a webinar that Brad and I did early on in January, where we talk a lot about those changes. So if you do need more on PPP, ubs.com/business-resilience.
Perfect. All right. Well, let's move away from PPP now and talk about some structure changes that we've had come in. So based on potential tax changes, should SCorp consider changing to a CCorp? Brad, I'll kick that to you first.
Oh my. Oh wow. That's a really, really good question, and one that is so specific that I would definitely refer you to your tax advisors and accountant. But switching from an S Corp to a C Corp, listen, under the Tax Cuts and Jobs Act, something that was also instituted is Section 199 Cap A, which allows a 20% deduction for pass-through entities, including S Corps. So it's trying to get that, get you from that highest marginal rate down a little bit more. It turns out the average tax rate was about 29.6% or something like that. Not close to the 21%, but closer than 37% is. And so, these pass-through entities that are able to take advantage of that 199A deduction, it may not make as much sense for them to switch over to C Corp land, especially given that it's considered a high priority under the Biden administration to raise the corporate tax rate to 28%. So I wouldn't necessarily see a broad blanket advice to people to switch to C Corp, given that tax rate is likely to increase, and we already have this new 199A deduction that has hopefully brought some of those rates down for pass-through entities, including S Corps. If you're not able to avail yourself of that 199A deduction, then it might make a lot more sense. But again, this is a very nuanced question. There's no blanket rule. But I'm just a little concerned thinking about that transition, given the fact that C Corp rates are on the chopping block, not chopping block, but on the those tax changes on the horizon. Yes, on the raising block. I don't know, whatever. Yeah, exactly. The opposite of chopping block. They're on the raising block to be raised to 28%, which would bring them very closely in line if you're able to avail yourself of 199A. So again, chat with your accountant about that one for sure.
Okay, we have another question about that. Does President Biden want to limit or remove the 199A deduction for pass-through entities?
Well, it's interesting. It almost doesn't even matter if he wants to, because that's set to completely go away at the end of 2025. So 199A, again, for those who don't know, it's just for pass-through entities, because again, C Corp's got this really wonderful reduction in their rates from 35 to 21%. And so they thought, well, that's not fair for all the ones who are just not organized as a C Corp, but organized as a pass-through entity, such as SCorp or partnership or a sole proprietorship. And so what can we do for those businesses? Well, 199A was to give them a 20% deduction on certain of their business activities, or on their tax return. But that's set to expire. The Tax Cuts and Jobs Act, as James mentioned, was all done through budget reconciliation. That process often means that you can't institute laws that will reduce the federal coffers over a 10-year period. And so you see a lot of this legislation come in just for a little bit and then expire, so it's not beyond the 10-year period. 199A is unfortunately one of those reductions, along with the estate tax and many others, where we're going to see, where we may see that completely disappear. So it's not on Biden's shopping block, maybe to make 199A slightly more aggressive in the sense of applying maybe for fewer businesses, but it's not necessarily there on the chopping block that I've seen, and certainly doesn't seem to be a priority. But just knowing that that's set to expire anyway.
I think if I could add to that, and this is just James's opinion here, but I think, and so that could be dangerous. But I think if you're thinking about what's the goal of President Biden, is his goal is not so much small business S corps and to go after them. It's to go after these large multinational corporations that are effectively paying 0%. That's the boogeyman. And so that's where my gut tells me I think we might be going. But I've been proven wrong many times, so we'll see.
No, I think that makes a lot of sense, though. That's a great comment. It's think about even for the new corporate AMT. It's really for only those corporations that have book profits of over $100 million, and many of those corporations like that are not organized as C corporations. With more than 100 million are organized as C corporations, less likely as pass-through entities. So it's a great point.
All right, I have a very specific question then for you. So if for someone considering converting from an LLC to a C Corp, one of the primary reasons for doing so would be for the investors to benefit from the existing tax treatment on capital gains. For example, tax exemption on the first 10 million of capital gains upon a sale after a 5-year holding period. So this person knows that they'd have to wait 5 years after converting to a C Corp before benefiting from this tax exemption. So
Yep.
do you think this favorable tax treatment will be touched?
So what they're talking about is called qualified small business stock. So it's for businesses that, or for owners or any shareholders who received stock at original issuance, so directly from the corporation, when the assets of the corporation were $50 million or less. If you hold that stock for 5 years and you meet a couple of other requirements, then you can sell it for the first $10 million is exempt from federal income tax. It's actually the greater of 10 million or 10 times the adjusted basis in your shares. So it could be much greater than 10 million. It's an incredible provision that if any of you can check right now, really call your accountant and see if you qualify as QSBS, your shares do. It's a beautiful exemption that allows that 10 million or more to be exempt from federal income tax. I have not seen, it's shocking actually, there are no regulations on that section. And so we all exist in that, in the tax world, we love and hate that because we act within just the bare minimum that we know, but we don't know very much because there aren't regulations where the Treasury has interpreted the Internal Revenue Code for our benefit to tell us how they think the rules should be applied. So we don't know. But that being said, the Biden administration and Democrats have not set their sights on this section for qualified small business stock, as far as I've seen. I have, even though it's a very, very taxpayer friendly provision in the Internal Revenue Code, I have not seen it discussed or touched. I think it's not well known, and I think that might be one of the reasons why. But certainly, if you're converting from an LLC to a C Corp for that reason and holding it for 5 years, it's anyone's guess in what will happen in those 5 years. But I haven't seen any discussion of that being talked about, it was good news for taxpayers.
I think on that one, and we have, from Brad's colleagues in our advanced planning organization, we actually have a small paper that talks about Section 1202, which is the qualified small business stock. And so, I don't know if there's a way that they connect with and with Vistage, but we can get that paper to you guys and share it. And it's a short, I think it's like 5 or 6 pages. Read it, connect with your tax advisor. I think I haven't heard much about it in terms of being a target, because it really is viewed as an incentive to start businesses. Right. And particularly, I wouldn't be surprised actually if there is a growing desire to have more underrepresented people starting businesses, minorities and women. It's a great feature for them, particularly, as they do it. So I wouldn't be surprised if you start seeing more actions for female businesses and minority-owned businesses to take advantages of programs like that, rather than target it. They're gonna find ways, alternative ways, like removing the step up in basis at death, perhaps, or reducing the gift and estate tax exemption. Those are probably ways that they can target, the ultra wealthy rather than true small business owners. That's my personal take on it.
Okay. Great. Well, as we wrap up then, James, what are some themes that you're seeing for 2021?
Well, I think my biggest theme that I'm seeing is, I'm going to bring it right back to where we started, which is about community and community of employees and suppliers and customers. if you're paying attention a little bit to the M&A news, you're going to see a lot more news about diversity of boards, diversity of companies, as just one example. So in December, the NASDAQ said, if you want to be listed on the NASDAQ, you need to have a diverse board, which something like 70% of the existing companies would not meet their requirements. So, and it wasn't that significant. I think it was like 1 or 2 seats, but you see that change. Last week, Carlyle was in the news that to get access to a particular fund that they're providing to middle market business owners, they wanted more diversity. So I think you're going to see more middle market business owners and C-suite executives thinking about sustainability and thinking about diversity and impact ESG type issues, which are currently increasing their importance in the public markets. That will begin moving to the private markets. And if we're going to find ways to find a private equity buyer, or find an institutional investor, or find a family office investor, I think those demands that they're putting on public companies will move towards that. And so I think it's beholden on us in this room, this virtual room, to think about how can we start moving the needle that way? How can we anticipate where the puck is going? And if you're waiting to sell your company, as an example, or bring in a new investor, and they want various ESG requirements, and you haven't done anything, that's going to be a real pain in the butt, right? And so thinking about it now, while you've got the ability to do that, a lot of companies, a lot of middle market business owners are really starting to think about how they can engage their employees, how they can improve diversity and sustainability, and do well by doing good, kind of a thing. So I think that's going to be a theme in 2021.
Okay, Brad, we'll turn to you. So what are you thinking for what the people on the call, what planning should be conducted now to prepare for any of these proposals? Should they become enacted, or what do you see for the year ahead?
Yeah, so I can sum that up with, usually get asked 2 questions about this. Should I harvest capital gain rates at today's lower rates in anticipation of a potential rate increase? And this can be translated into a question for business owners is, should I sell my business at today's lower rates, capital gain rates, in anticipation of a potential rate increase? So although capital gain rates, of course, may increase under a Biden administration, it doesn't necessarily mean that paying taxes today at the lower rate is better. As our chief investment officer has put it, the effective compounding returns really complicates this analysis. So paying taxes at today's lower rates means eliminating investment possibilities on the cash used to actually pay that tax. I always remind people the IRS only accepts cash. Deferring the payment of taxes, however, allows that cash that would have otherwise been payable to the IRS to remain invested for your family's benefit, or your benefit, your business's benefit, whatever it is. So even if you realize gains with a higher tax rate later on, you may be able to end up with more after-tax wealth if the invested cash earns a high enough rate of return over a long enough time horizon. So that's what just an analysis I would look at. There's no reason to hurry up and sell a bunch of your stocks right now. Unless there's a real short-term liquidity need. And that's how I would assess the sale of your business as well. Again, a really great retort to this question is, well, in 4 years, we may have a whole new president. President Trump may be back in office where he eliminates capital gain rates. Who knows? We have no idea. So those may go way back down again in 4 years. So don't force yourself to let the tax tail wag the dog for your really important life decisions today, especially when some analysis might prove that you might end up paying more taxes over the long run. And the second question is, should I engage in estate planning in light of possible changes to estate and gift taxes? And here I have an unequivocal answer: yes. While President Biden has proposed the gift and estate tax exemption, changing it from its current all-time high of $11.7 million. That's the amount anyone can give away gift tax-free during their lifetime. He wants to lower that to $3.5 million, make it much, much more aggressive, apply to many, many more people. Those changes are anything but certain, particularly with some moderate Democrats, as I mentioned, on record in favor of eliminating even estate tax, not making it more aggressive. But what's more is making the decreased exemption amount retroactive produces these absurd and punitive results. So, using the exemption here while we have it is going to be a real priority. There's never been a better time, and James has heard me say this now for almost a year. There has never been a better time in modern history to shift wealth outside of your estate. Asset values in many sectors are still temporarily depressed, hopefully, requiring in many cases less exemption to shift more assets out of your estate. Interest rates are at historic lows, and many estate planning strategies become more efficient and more effective in lower interest rate environments. And finally, making significant gifts during one's lifetime removes not only the asset you gifted, but all of the subsequent appreciation from your estate. So again, I like to think of it as when the tax man or woman comes along your death and tallies everything up, everything that you own, takes a sum total and says, I'll take 40% of it. Well, your goal is to shrink that pie of wealth by the time of your death. How do you do that? Gift assets into trusts that benefit your family that you can still have a little bit of control over. And this is a year to do it. Why? Because you can gift more assets, more business interests now than you've ever been able to in modern history. And that truly is on the chopping block.
And I think if I just to quickly add on that is you can hear Brad's passion for sure. It's critical for the folks on this call is you don't want to go it alone. You want to talk to a team of advisors, your tax attorney, a tax advisor, your state attorney, your M&A attorney, whatever it may be, your financial advisor. And so again, shameless plug for UBS, but whether it's us or one of our competitors, talk to your financial advisor because they're generally not billing you hourly, and think about what your goals are. And perhaps your financial advisor can bring a person like Brad or me to talk through your goals, what they may be. And, an investment banker, your attorney, your CPA, bring the team together and have a discussion about what your goals are for you, your family, and your business. And what does all of that mean together? A lot of times people are thinking just themselves on their silo or just themselves and their family. They're not bringing the whole picture in. So have a conversation and start thinking about what your goals are. And that, I hope, is the number one takeaway is you've got a lot to think about. I need people to talk to it about.
Right.
I think that's always our takeaway. And you, James and Brad, are a tremendous resource for our Vistage community and small and mid-sized businesses. So thank you so much for sharing your insights today. And thank you for our attendees for your time today. We've put a link in the chat to the webinar that James referred to, so you have that access. And we'll also send you a link to the recording of this session in 24 hours. So don't miss our next Peak Performer webinar on March 12th. Aisha Tompkins from Insperity will share insights on making inclusion a part of your organization's culture. She was with us last year, and that's going to be some great insights for our community as well. So you can register for that at vistage.com/webinar. That's vistage.com/webinar. So thank you to our attendees. James, Brad, have a fantastic day, and we'll see you for our next session.
Thanks, Anne. Appreciate it. Thank you, Vistage. Thank you, everyone who joined. Be well.